The overview of where we are, and I think it's fascinating to see how people are moving to monetize in this world where there's this direct competition to get streams.
All right. Well, streaming is obviously where it's all at right now. I'm curious, just in your job as an attorney, as someone who puts together deals for artists with record companies, how have the economics of streaming changed those deals?
Well, they're changing it in several different ways. For one thing, in a streaming world, I'll answer non-economically first, but for one thing, in a streaming world, albums are quickly becoming irrelevant. They're still doing it because we're used to it, but if you're seeing artists release 1 or 2 tracks at a time, 4 or 5 tracks at a time, it doesn't really have the same boost to it. The historical model for having an album was that the record company could make so much profit on the album that they could afford to put a lot of marketing and money into it, have a big event, have the artist tour around it. We talked about album cycles. All the record deals are based on delivering a certain number of albums. And now that's all becoming muddled because you don't get the same spike that Tom said earlier that you got when you had a successful album and a burst and a concentrated marketing campaign around it. So they're all scrambling to figure out how that's going to change. Almost laughably, the record companies have to default back to how many streams, okay, what does that translate to in number of album equivalents? I mean, they're so used to thinking in terms of album sales that they don't have another metric that they're adopting yet. It's changing and it's all starting to move, but we're truly talking about a moving target, which is one of the challenges I had in updating my book is the target is moving so fast I haven't been able to get a handle on where to grab it to make it not irrelevant by the time it comes out. So in terms of product, we're starting to see people play with how to not deal with albums. And on the publishing side, the songwriters, they've already pretty much abandoned the concept. It used to be you had to record and release a certain number of tracks in physical format, which is clearly becoming irrelevant. And now they've just gone to basically, okay, we give up, but you have to recoup in order, you have to get your money back. We have to earn back enough money to pick up our advances in order to move your term forward, which has another set of problems. Term can go on forever. The other thing about the economics, which is really what you were asking, is if you're in urban and rap, the economics are through the roof. But as Tom indicated, they're almost banking transactions. You can pretty accurately predict with a certain amount of data and transactions what somebody's going to stream, and you can present value the money and give it to them. And then, of course, if there's competition, they get stupid about it and they want, they'll overpay. But for the first time, we're starting to see deals really build up in that area. The other genres, not so much. The other genres are kind of as they were, if anything, a little bit maybe out of favor because that's not where the massive money is in streaming these days, and people are a little more conservative about it. But at least for the first time, we're seeing companies feel flush and companies starting to become aggressive and compete again.
I've also found recently, I've been looking at Amazon and Google and the sort of new entries into the streaming market, and they're finding their lanes too. Like Amazon, I don't know if anyone's noticed, but they've really got a hold on children's music. Like that is their, when it comes to music, if you're a cool artist like a Courtney Barnett or a Lisa Loeb, you can make a children's album and sell it to all your fans who now have kids. People are finding just different avenues in which they can really grab onto things. But one persistent problem has been YouTube. I just came back from MIDEM, which is a conference in France, and the value gap, which they talked about last year, is exactly the same. Literally nothing has changed in a year. And it really comes down to what YouTube pays, which is about $1, and what Spotify pays, which is more, 10 or 20 even. Per user. So what is going on with YouTube? What is the clash here, and is there a resolution?
Yes, I can tell you the clash. I can't tell you yet if there's a resolution. The clash is that YouTube is basically giving away for free what the streaming services are trying to sell. And yes, they sell advertising around it, but they don't monetize it anywhere the same way for one very specific reason. There's a quirk in the United States copyright law and a similar provision in other territories that says the following. It's called a safe harbor. Let me give you an example. I'm a newsstand over on Cahuenga Boulevard in Hollywood, and I sell an issue of Time magazine, and in that issue of Time magazine is an article that infringes somebody's copyright, right? Now, in theory, under the copyright law, I'm distributing a pirated or infringing copy. I'm liable as a distributor. There's a distribution right in the copyright that says if I distribute something copyrighted, I'm also an infringer. It's to keep you from, you know, it's an independent right from the copying, but then there's a distribution. Okay? So when the Digital Millennium Copyright Act came along, they rather innocently put in a provision that nobody anticipated the effect of, that said if I'm a digital service provider, Google, YouTube, and I have a user post something that's an infringing copyright, the fact that I am such a big thing with so many people posting stuff that I can't be liable for copyright infringement unless you send me a notice and say, hey, you've got an infringing copy, then I have to take it down. And if I don't take it down, then I am a copyright infringer. That sounded great when they were writing the Digital Millennium Copyright Act. What happened was that nobody anticipated the billions of streams that would go through YouTube and the tens to hundreds of thousands of infringing works that would go up. And so the labels started to fight it by sending takedown notices saying these are all infringing, and they would very quickly take it down, and then the next day some other user would post it again. See, the thing with YouTube, which is different from Spotify, Amazon, Apple Music, is that YouTube is not putting the music on their servers, their users are doing it. That's the key distinction. And because it's user-generated content, UGC we call it, it's a different set of copyright rules. And under that, they basically skated through the copyright law and were paying nobody. So they came to the labels and they said, the publishers, and they said, okay, here's the deal, we'll pay you a little bit and you can get something, or you can continue your whack-a-mole game with the copyright notices, we'll take it down, they'll put it up. And the labels all took the deal, but it is a fraction, as Shirley said, of what's paid by Apple and Spotify on a what's called an ARPU, which is the rate per user. So it is the biggest problem we have in the industry. It looked like there was going to be some traction. And the other side of it, of course, is who do you think has more legislative clout? The music industry, who I just gave you the figures, or the tech industry, who in a day makes what we make in a year. So who's going to have more clout in Washington? And this Congress is not likely to do anything against them or against much of anybody. In Europe, it looked like there was some traction where they're not quite so tech enamored, but that got derailed by the Brexit. And while it's still chugging along, there's no resolution. But that would be a solution. If they actually came back and said and changed the safe harbor in Europe, we would have a shot at making a deal with YouTube that looked more like market.
That's a lot to take in. By the way, it's so complex, our copyright system. Again, like just coming from Europe, where I was just a couple of weeks ago. You know, Carrie Sherman, who's here, can probably talk about this more, but the squiggly lines of like, your copyright starts here, and the process that it has to go through in order to actually pay the songwriter is just, it's insane. But speaking of paying, so artists who are legacy acts, who were signed in the heyday, who sold millions of albums, if you're representing them, as you do, and they come in and they want a new label deal, is it sort of like a rude awakening for them to see the economics and how much they've changed?
Well, if you're a legacy artist, the rude awakening is that nobody wants your new music. They go to the bathroom during your concert when you play it. In other words, the legacy acts, none of them really have any current product that means much of anything. That's sort of the rude awakening. I think it's, some of them are like old men on a park bench complaining about the good old days. A lot of them embrace it and understand that the tech is a way to reach fans and to stay in touch with people. The ones that understand who they are and capitalize on the fact that people want to hear the music that they made in their heyday, can have quite a nice career, but it's mostly around touring. They don't sell a lot of records and they don't stream very well for the most part.
But it's interesting because there's another little anomaly at the year-end report that IFPI put out. It said the catalog and deep catalog was more than half of streaming plays. So you're basically going to something that you're familiar with. Deep catalog being like over 10 years old and catalog being like, the last, let's say 10 years. So it's kind of interesting. It's like, yes, it's the delivery of new music and it allows you to discover stuff, but at the same time, it's really about ease of access to the stuff that you already like.
Yeah, and in fact, my prediction is the music business is going to be bigger than it's ever been, and I'll tell you why. In the heyday of the music business, an average consumer would spend maybe $20 to $30 a year on CDs. I've heard as high as 40, but somewhere in that range, right? If that's the average sort of user. Obviously, the freaks bought more, and a lot of people bought nothing. In the streaming world, people are monetizing at a rate of, given family discounts and stuff, about $7 a month. That's $84 a year. And the demographic range for the streaming is massive. It's people that, older people that are streaming and who would never go to a record store, because in the heyday, people stopped going to record stores in their early 20s. Now people are listening to music at every age, and it's getting monetized, unlike the radio, where it wasn't for the record companies, it was for the songwriters, but not the record companies. So the potential of the business of streaming, once people get used to it, I think is going to be massive. I think we're going to be bigger than we've ever been by a large factor.
So there's hope.
Absolutely.
Oh, great. Okay, so 10th edition coming out soon. What are the sort of changes that you've had to make in these last couple of editions? What are the things that you constantly are finding yourself updating?
Well, it's all around the digital. I mean, it's all around the things that didn't exist in the prior edition, and as they begin to fall into a pattern, because whenever there's a new technology, there's a predictable cycle of the artists getting paid less than they should for legitimate reasons. The industry is spending money on something that doesn't make money. Then we go through a period of trying to figure out how they should get paid, and then they start getting paid, and then it creeps up as they renegotiate or make new deals. And we're in that cycle with all the digital now. But the updates and the additions just had to do with things that didn't exist before. Digital bundles, internet radio, Sirius and satellite radio. I mean, none of these things were in the earlier editions just because they didn't exist.
And do you find that they're easy to grasp? Because the old system was it was very basic. It was sort of simple, and now it's just, like I said, so complex. And I've talked to lawyers at record companies who've admitted that they don't know what half the contracts mean sometimes. So what, can an average, I want to be in the music business person understand these complex situations?
If you take the time to do it, yes, because ultimately it just comes down to how much money do I get out of each particular exploitation. But it is very complicated. Interestingly, the record side of it is pretty simple. That's not that complicated. The publishing is horrendously complicated.
Yeah.
Publishing meaning the songwriters. For various reasons, regulations and so forth, that gets incredibly complicated. But the record side is relatively straightforward.
Okay. All right, well, I wanted to open it up to questions to Dawn. And then, since there's a good segue to go into publishing with John Josephson. Any questions?
Right here. Hi. Can you talk to us about the streaming rates, and is the MMA a good solution for that?
Okay, the streaming rate is negotiated. Under the copyright law, there's no mandatory license for it. So the streaming rate is what's negotiated between the record company and on the record side, and the record company and the streaming service. It's in the somewhere in the 50% range, a little over, depending on the label. The deals aren't public, but it's about that. The publishing on top of that is about another 12%, roughly, counting both performances. That's where we get into complexities, but in general, those are about the range of things, that may be a little bit off one way or another. As the MMA a solution? Yeah, probably. It's a little unclear as to exactly how it's going to end up because people are changing it, but it's the first time that we've gotten everybody, including the digital people in the music industry, to all buy into something. And I think it's probably a good thing.
I've heard, and I don't know if it's true, that 1 million streams is about $7,000 to the label.
A little less.
A little less, like 6,800?
Well, it depends on where the streams are and whether they're paid.
Oh, right, paid.
And whether they're on YouTube
Right.
and so forth. But a safer range is probably 4,000 or 5,000.
Okay.
But somewhere in that range, depending on where, and also whether they're in the U.S. or foreign.
Right. Okay. Any other questions for Dawn? Yes.
I guess, so
In motion pictures, we've seen the platform companies be very successful using the data and the control over the customer to create original content. Why haven't we seen more success out of the streaming companies in signing new artists, doing the same thing?
Well, the streaming companies haven't really made a decision to go into the content side of it. Historically, distributors have done a terrible job when they try to go into the content side of it because it's a completely different business. You would certainly, and I don't think it translates as easily as the music business where, for example, as the film business where, for example, you can see a particular star has a lot of popularity and people want to see something that star is in. You can know that they want to hear a particular artist, but that's not hard to figure out, and always has kind of been the case. And you can know what genres are important, but that has more to do with signing and cultivating and curating, I think, that it does with actually just sort of, hey kids, let's put on a show, using the elements we know are going to work. I think that's easier done in film and television than it is in music, but that's just my opinion.
But that's sort of what I was saying about the children's music. It's like that is something that they are owning.
That's an addressable market.
Yes, absolutely. And it doesn't feel like it's being addressed
I also
exactly.
wanted to give Mike Smith's book a plug.
Oh, bless you, sir.
What's the title?
Streaming, sharing, stealing.
Streaming, sharing, stealing.
I like it.
Wait for our autographed copies. Yes.
One of the things I really enjoy about your books, each time they come out, is it talks also about the people jobs, who you bring around your tribe around you as an artist. With the increase in things like label services companies, in the next generation of the book, are you going to have a lot more on the next generation of people roles or other types of companies?
You're talking about inside the companies, or you're talking about independent advisors?
Independent advisors and that whole strata of expanded folks.
I haven't seen it change as much. If you have, I'd love to hear your input on it. I haven't seen a radical change in that. I mean, we're still kind of doing what we were doing before. We're just grappling around to figure out what the terrain looks like so that we can make a new battle plan.
Let's walk.
Okay. Anyone else? Yeah.
Can I ask one more question?
Yeah, of course.
So it seems like with the change in the revenue model you talked about, the labels would all of a sudden have to worry much more about which other label is releasing a big artist this weekend. Because it is a zero-sum game. Have you seen that in label behavior? Where now I've got to worry about 10 polls almost.
Yeah, it's a good question. I don't know the answer to that, just because I'm not on the label side of the marketing or the strategy side of it, so I haven't directly seen it, but it's a good question, and I would think one that would make some sense.
And yeah, I do think that happens. Like, I think there was recently, the J. Cole album came out, which was a huge success and very, very popular, but it dropped the same night as a new Ariana Grande single. And wouldn't you know it, like, within an hour, it was all about Ariana. Now, if you have a very strong body of work like that J. Cole album did, it had some legs and it kept going, but it easily could have been overshadowed and erased, So it happens.
Don, can we turn our attention a little bit to music publishing? What do you account for the investment flow that is hitting the market for exacerbated value music publishing catalogs? And do you see that bringing more for established, steady state catalogs in the music? And what do you think the future is for that business?
All right, so the question is, what's been the changes in the valuation and sale of music catalogs? Is that right?
Fair enough.
Yeah. Definitely the prices are going up. It depends on the catalog, of course. We're shifting away from the traditional where airplay was, stable, and you could see that there was continuous sales and continuous income, to where we're moving to the streaming world. Everything is going to change in terms of how it's monetized. But I'm certainly starting to see multiples of the companies going up. I'm starting to see more money chasing it. The publicity about the growing music industry, even if the per use may change, the ships are all rising, I think has driven the values. But I'm definitely seeing more activity, more people chasing it, more outside. Wall Street woke up maybe a year or two ago and saw the growth in the industry and started sniffing and getting interested again. So I think we're seeing more buyers and more competition and higher multiples.
We'll definitely talk about that in the next Q&A. Okay. All right, I think we're good. Don, thank you so much. I have to follow both microphones. All right. Last but not least, John Josephson, who's the chairman and CEO of CSAC. Earlier this month, Variety ran an article that we called CSAC Cheap. John Josephson is bullish on the future of music rights. And we drew parallel to what John was just talking about. CSAC itself was purchased by Blackstone for a reported $1 billion. And in April, we had a successful IPO by Spotify. In May was the sale of Mubalala's interest in EMI to Sony ATV. There's a lot of activity in investing in publishing. So what does that say about the value of music publishing today?
Well, I mean, I think that when you think about the value of music publishing, you have to think of it in the context of what you expect the underlying growth in the industry to be, where you know, publishing is a long duration asset, so changes in interest rates tend to have a very significant effect on the value of the asset. And then you have to think about, you know, in the market today, people's expectations of what that underlying growth rate is likely to be relative to what it actually is going to end up being. You know, there's no question, going back to what Don said a moment ago, that there was a research report that Goldman Sachs put out, I think it was in November of 2016, which is really market seeding for what they anticipated would be their role in the Spotify IPO. About 2 or 3 months after that, you had Blackstone buying our business, which I think a lot of people in the industry don't really focus on very much, for a relatively significant amount of money. And as you point out, there's just been continued flow of transactions that once seemed to be very high value. And I think that, you know, that's brought a lot of interest from outside, a lot of third-party private equity money that's interested in the industry, because I think for a variety of reasons, including people discovering the fact that the industry is returning to growth again, combined with the fact that, you know, a prominent private equity firm will be making that size of a bet in a business that's effectively a derivative of music publishing. That's all, you know, conspired to create significant interest, which has led to increases in prices. And I think at this point, you know, someone asked the question before about whether there's third-party money coming into the industry along the lines of a lot of the structured vehicles that were used for financing films in the past. And I think it's much more prevalent on the music publishing side than it is on the recorded music side. And when you look at a transaction, you know, without calling anything specifically out, but Cobalt acquired Songs Music Publishing recently. My understanding is, you know, Cobalt is building a sort of global monetization platform for music rights. They also are a music publisher. A lot of the money that I think they're using to fund their music publishing acquisitions these days is third-party capital from private family offices. And, you know, I think it creates the same sort of potential issues for conflicts that existed within the film industry. It's going to be interesting to see how a lot of these things prove out over time. But it is definitely the case that, notwithstanding the fact that the industry is growing again, you know, people are implicitly or explicitly making some very heroic assumptions about what that future growth is going to look like based on the prices they're paying today.
Publishing is more attractive to an investor because it's more stable and less risky than the recorded music side?
That's correct. I think the perception within the investment community is that music publishing historically has been a much more predictable, some would say potentially more boring, but you know, it doesn't have the sex appeal of the recorded music business, but it's the equivalent of buying catalogs of previously released feature films or television shows as opposed to financing new production. It's a business as opposed to something that involves intrinsically an enormous amount of risk and uncertainty around what's going to work and what's not going to work. I do think, as was said before, that, you know, the world we're moving into and the ability to really track consumer behavior and consumption is going to bring a lot more science to the art of putting new releases into the market. But it still is the case that, you know, publishing is just much more of a, you know, nuts and bolts business with a significantly higher degree of predictability, although there are variations around that theme. I think songs which was a company that was started by Matt Pincus, who did a brilliant job building it, was really focused much more on front catalog, had a phenomenally talented A&R team, and they were able to actually approach that and build a real business. So, you can see both sides, but, or what I really mean to say is, both, frontline and catalog exist in publishing, but publishing is much more of a catalog business, I'd say, from an investor perspective.
Right. So also at Meet Denver, this was a big topic. I understood that the predictions on music publishing are pretty, like they're not going to shoot up. They're pretty flat, even for the next 20 to 30 years. What's your assessment?
I mean, I think, you can't answer that question without talking about whose predictions you're talking about. I mean, if you look within the financial, the investment banking community and the analyst reports that are published, again, I don't have specific examples to cite, but I think they reflect substantially. A lot of them reflect, for at least the next 5 years, let's say, significantly higher rates of growth. I do agree with Don that, he correctly points out that the industry is still a shadow of what it was previously. I think there's, a significant good run ahead of the industry, whether it goes on perpetually or whether you reach sort of an actual asymptotic level where it gets harder and harder to get more people to pay for music on a streaming model. That remains to be seen, but clearly, I would say at least for 3 years, perhaps 5, 7 years, you've got double-digit rates of growth, I think, as opposed to single-digit rates of growth.
It explains why you're so bullish on the future of music rights.
I have to.
Well, since you came from finance, I'm curious, what has traditionally been Wall Street's view of the music business, and how has that changed since the streaming era?
Well, I mean, I think that you have to break that into eras. So in the era of the CD, again, more from an M&A perspective than an actual investing perspective, there was just a lot of activity within the music industry, principally on the recorded music side, a lot of focus on it, and people made a lot of money off of it within the financial services community. I think during that period of time, there was a continuous amount of investment on the publishing side. So from the principal, investing side, there was, an ongoing level of interest. I think starting, you can pick your date, but let's say just, circa 2000, 2004, whenever you want to start, the recorded music industry went through a prolonged downturn. And I think that it's natural, people who cover industries from the outside, they don't have an enormous amount of time to make, engage in nuance and really parsing a business. So in this period where you saw basically a 50+% decline in the recorded music business or overall industry revenues, the common perception of the industry was that it was a disaster. Now, that hides significant pockets of growth. Now, our business, which I always, and it's our core business now because we've broadened our business since I joined the company, but our core business, legacy business of performing rights, which I always describe as sort of sitting at the intersection of commercial, businesses exploiting music for commercial purposes. And unlike consumer, it's much easier to find a business and force them to satisfy their obligations under the Copyright Act than it is for a consumer. That business, actually, performing rights, grew consistently during that entire disastrous period for the industry. So our business, we've never actually had a year. I invested in the company originally in 1992. We've never had a year where the business didn't at least grow at a low single-digit rate. And most years it was growing because we were taking share away from our competitors at, much substantially higher than that. I think that because publishing relies to a large degree on performance, publishing has been a much better industry over the past 18 years, let's say, than recorded music has been. So, people tend to sort of tar the entire industry with their perception of what's going on in one segment of it. And I do think, just going back at the risk of beating a dead horse, Spotify, its success in the market, the return to growth, the Goldman Sachs report, our deal, the deals that you mentioned subsequently, has resulted now in a complete turnaround where people think that there are huge growth opportunities in music. When I was in finance, I worked in film, television, music. I love IP-based businesses, but I didn't take the job because I'm purely and only and singularly a devotee of music. I knew the company well and really had a strong appreciation for it. But people used to ask me, like, you're not doing this full time, right? You're just doing this part time. You wouldn't actually conceive of going to do anything in music per se. And of course now they all say, oh, that was really prescient, which it wasn't. It was just an opportunity that presented itself. But that's the nature of the investment world generally. So we're in a period of sort of ebullience, not clear yet whether it's transited into irrational exuberance, but clearly people are making some very constructive, on the investment side, assumptions about the future of the music industry right now.
So exciting. Tell us a little bit about CSAC, because what I've learned about it in these last few years, working at Billboard and now Variety, is that with CSAC, really size matters. You have a smaller affiliate group, so you can provide sort of higher level of responsiveness and service. It's also a for-profit organization as opposed to ASCAP or BMI. So what else differentiates CSAC from the other performance rights organizations?
Well, again, let me parse that into two parts. Let me talk first about our legacy PRO business. You know, as you point out, ASCAP and BMI, which are our principal domestic competitors, there's a new entrant that's also unregulated that Irving Azoff started called Global Music Rights. But let me focus principally on ASCAP and BMI. Those have been for many, many years subject to consent decrees with the Department of Justice that impose significant restrictions on them, behavioral restrictions on the way they license music, and they also impose restrictions on them in terms of they have to take all comers. So anybody who wants to affiliate with them, they have to take. They are both nonprofits. Actually, you know, technically speaking, BMI is a C corporation, which is a for-profit entity, but it is run and has been run since, you know, within the first decade of its founding as a nonprofit for the benefit of its writer and publisher affiliates. ASCAP is a member-owned collaborative. So, you know, as you point out, we're very selective in membership. We really try to focus on high-value copyrights and then extract the maximum value. We are not subject to the same behavioral restrictions that ASCAP and BMI are when we license music in the marketplace. We think that allows us to achieve over time better licensing outcomes. So we, you know, believe that we can generate more revenue for the works that we represent than they can. We have a smaller affiliate base, which we believe allows us to be more responsive in terms of the service level that we provide. We are a for-profit entity, so, you know, I like to describe our domestic PRO business sort of as a merchant model. You know, the only reason why people leave ASCAP and BMI and come to us is because they are very, very certain, and in most cases that means we're guaranteeing them that they're going to make substantially more than they can make with ASCAP and BMI. When we make good bets about where we can license those works or those artists' works or writers' works in the marketplace, we make money alongside of them. When we bet wrong, we lose money. So we view our affiliates as partners, whereas ASCAP and BMI view themselves as agents on behalf of writers. They're very focused on paying out you know, the maximum amount of revenue that they generate. We're much more focused on maximizing the amount of revenue that we generate and then sharing the, you know, proceeds of that work with our writers. So that, for our PRO, is, you know, the sort of the principal areas of differentiation.